This is the worst I've ever seen. I mean, I've never seen bonds and stocks go down this much. And I hear on a global basis, it's the worst ever. And it's early on. Right? I say it's early on because I keep asking myself, what's going to stop it? Not the Fed. We need to see that pivot. I don't say they're going to ease.
In today's video, Mike McGlone, senior commodity strategist at Bloomberg Intelligence, discusses the Ethereum merge, the Federal Reserve's rate hikes, and how markets are reacting to Fed decisions moving forward. He also discussed long-term bonds and Bitcoin's evolution. Before listening to him, please ensure to smash the like button and subscribe to the channel. Let's dive into his last interview now.
How significant is the merge?
Well, it's good that we've got this period over with. I think the key thing to realize here, it's got a pretty good pump with all the publicity, and it's risking a significant reversion back towards $1,000. I think the big picture to think about with Ethereum is it's revolutionary. Just like I came from the futures pits and they revolutionized finance. It's revolutionizing finance like futures and ETFs. But right now, we get through this merge, and we have to worry about potential bumps in the road, which we all know happens with this kind of technology. And remember, I'm a markets guy, the technology guy. I depend on other technology stuff. I depend on other people for it. But the thing is now, then we have to turn over to the macro big picture. What's been pressuring cryptos this year? And that is the Fed sledgehammer. And I think that's my focus. I mean, I've written about Ethereum and just kind of lighten up a little bit with all this merge talk because I'm just afraid it got too hyped, and now now let's do it. And I'm worried about the short-term pain for a longer-term gain in all markets. Definitely a lot of the good news priced in for the short term, but it's within a significant macroeconomic, broad-based bear market for all risk assets. I mean, even housing markets turning over. Even bonds are down. It's that macro, and it actually might be one of the biggest bear markets in most of our lifetimes. And I'm almost 60 years old. And I think it's just early days because I've never seen this before, Michelle. We have that much aggression from the Federal Reserve and within a market, a global economy that's really tilting significantly towards recession. I mean, we have a Bloomberg economics tracker that's pretty seriously a good indicator in 2008. It's gone negative for a global economics tracker. So that's the macro. You dig into the cryptos, and I think what's really happened this year is the markets realize that this Bitcoin thing is one of the world's most significant leading real-time 24/7 traded leading indicators. It's just indisputable now. I mean, it come Friday happy hour, that's when you really see it. And Saturday, you see what's going on. And Sunday, you see what's going on. And it's signaling risk off in one of the most significant risk off markets I've ever seen. I think we're going to see more of that, but I think it's going to come out ahead. Bitcoin particularly, because I think Bitcoin's going to be trade more like U.S. long bonds and gold, which had a problem today, which is indicative of the problem. And Ethereum's so revolutionary because one thing that's most notable, I like to point about Ethereum, it's making the most significant thing happen that I just find revolutionary, and that is the tokenization of assets. Most notably, the most widely traded crypto on the planet, our tokens, are dollars. Ethereum made that happen. Yes, there's competitors, but Ethereum was the leader. Tether's one of them. There's a dozen crypto dollar wannabes, people call them stablecoins, but people are realizing how revolutionary this technology is, and they all know, most people realize, okay, I've got to adopt or fall behind. Now, what does that mean for the price of Ether? Okay, it might go back to 1,000, might even get a bit lower, and I think in the next 5-10 years, it's going to go much higher. But right now, the key thing for all cryptos is they're about $1 trillion space. The global equity market's $100 trillion. It's already lost 20. It's probably going to lose another 20. And I don't see what stops that right now. That's the problem. Is this Fed sledgehammer is revolutionary. It's that unique in the midst of a global economy that's tilting towards recession. So to me, that's how macro is. But you look at this 5 or 10 years from now, and that's where I think cryptos are going to really make the difference. But I view it as like the year 2000 and the internet bubbles just starting to roll over. The Fed will not be easing anytime soon, and it's classic human nature because now we have the benefit of knowing how far and the mistakes they made by easing too much. So that's the key thing I like to see. Looking in the rearview mirror, it's very clear the pendulum for risk assets swung way too far to one side. And looking forward, into the front of where this car is going, it's very clear that pendulum is going to be swinging back significantly the other way. The Fed is a leading part of that, but it's just not going to happen that they're going to ease like they did during the 87 crash and during just when we plunged in 2018, and most significantly when we plunged in Q1 2020, because they know now they are somewhat responsible for this massive inflation. It's the key things I like to come back to, and cryptos are a leading indicator here. Is when it gets this macro, you have to go to the key rules of macroeconomics. Number one, inflation is always a monetary phenomenon from Milton Friedman. And number two, the Adam Smith rule of the invisible hand. And to me, that invisible hand is just kicking in massively, where you throw money at people, they buy too much, they extend, and now it's all going back the other way. So that's the key thing about cryptos. It was the most speculative leading indicator I've ever seen. It still is. I mean, on your phone, this stuff trades 24/7 globally, fluently, and it's really, it's revolutionizing how people can get access to other currencies than their melting currencies, like certainly the Dow or Bitcoin. But now it's going towards, okay, we've gone too far. 2000 we did, and then we dropped, and it took 13, 14 years to get back above that old high in equities. I see a similar case. This is 1929 and the Fed's tightening. It's very much happening that way. Look at things like crude oil. We just have the biggest pump in crude oil versus this 100-week moving average ever, crude oil futures. And now it's reverting. And what typically does is the pendulum swings back too far. And I think we're in the early days of that. So I don't think they're going to get too cheap, but I think what's the bigger thing is when the dust settles from this, because the Fed's not going to be easing anytime soon. That number one way to stop the Fed from easing is markets have to go down, unfortunately. Otherwise, they're just going to hang out and wait until that inflation goes down. And what's the best way to make inflation go down? Markets have to go down. Cryptos are just a small part of that. But that's why I think the macro is overwhelming. And I think it's, when I see a storm coming, I think it's somewhat my duty to warn people. And just telling this is my true feelings of what's happening. I ask people, and I'll ask you this, and even our listeners, what stops this? Is it going to be the Fed? Is it going to be a stronger dollar? Does the dollar has to reverse? No. Is it going to be global economy coming out of it? No. Is it going to be China coming out of it? Very unlikely. I don't see what stops it at the moment other than risk assets going lower and reaching a lower plateau and us resetting. I'm afraid we're going to have a second half similar to 2008 when things went down really hard. But then they came back. They bottomed, S&P bottomed in March in 2009 and came back. But to me, this is more the enduring correction that everybody knows we're overdue. The Fed's taken away the punch bowl that's worked for 40 years, and we just need that reset. And we had the best, I would say, foundation ever for that. The plague just put too much liquidity in the market. The key thing is, I think, is let's look forward to where's the opportunities here. I fully expect this massive backup in bond yields is going to stop and create a great opportunity. That 40-year bond bull market, I don't think it's over now. I've been wrong. I've been too early. But that takes the Fed has to stop, because I think this is going to be very deflationary. Just look at crude oil. The price on the screen right now is the same price as, I think it's October 2007. Imagine if we said that in the stock market. But I think that's what we're going to do. We're going to look back and say, okay, the stock market's the same price as it was 5-10 years ago. No, we haven't said that in a long time. I think the things that are going to come out ahead is Bitcoin eventually, because Bitcoin's going to transition to a trade more like gold in long bonds. And that's the key thing why I wanted to bring gold in today. The fact that gold's down 2% on kind of a meh day is indicative to me of people just hitting their stops. Just get me out. And I think, gold should come out ahead, but this happened in 2008. I think this is the big one where, I'll give you an example. 1929, the stock market went down 50%. Then it rallied 50% up to 1930, and then everything went bad. And unfortunately, for the Fed to stop this sledgehammer, risk assets have to make them stop by tightening for them. There's a lesson I learned working at some hedge funds, and one hedge fund, my hedge fund manager told me that lesson is bear markets can take money from everybody. This is the worst I've ever seen. I mean, I've never seen bonds and stocks go down this much. And I hear on a global basis, it's one of the worst ever. And it's early on. Right? I say it's early on because I keep asking myself, what's going to stop it? Not the Fed. We need to see that pivot. I don't say they're going to ease, but at least for them to signal, we're done tightening. Inflation's not going to be a problem. We expect it to decline. And if stock market, we wake up one day and it's down 10%, maybe down 10% another day, and 10% another day. That's what happens. That's what we typically, I think, need to shut off this sledgehammer. Right now, the fact that everybody's losing is just going to stop the ability to buy stuff, as Jim Bianco says, and that's what we need. And we're not there yet. That's the problem. The data that's still coming out is people are still buying stuff and boosting inflation. Even housing, the housing is starting to look really, I looked at some housing numbers today, and to me, it looks worse than it was in 2006 before it dropped and didn't bottom until 2011.
Explain how you see this whole institutional interest now playing out, especially in the context of the macro environment.
Well, that's it. 2 words: cash flow. When you can, we published, my colleague Jamie Coots, who's based in Sydney, published on Ethereum and its potential cash flow. That grabbed the attention of a lot of people on the Bloomberg terminal who are equity based. I mean, I can get involved in this nascent technology. I mean, I saw what happened in Blockbuster. I saw what happened in Kodak and everything, and get cash flow, and I can do discounted cash flow analysis on it. That's what brings in the massive institutional spending space. Slowly, it's trickling in, but that's where Ethereum is very attractive. And what it does, the utility of Ethereum is phenomenal. I mean, what stops tokenization of all assets? Yes, regulation is short term. So that's what I think that's the key thing. It brings in that cash flow. ESG, yes, I'm afraid of potential bumps in the road, but that's the key thing when people say ESG with cryptos. I'm like, you got to remember the S and G when it comes to Bitcoin. I mean, I just hear constantly from my colleagues overseas that, Mike, this is a great way for us to diversify. And I even hear it from, clandestine sources in China that we can get access to the dollar and other currencies than our yuan through our phones, through this great technology. So from an American standpoint, where, money is like water to a fish, the rest of the world understands this, and that's why I think the U.S. regulation is not going to mess up. Now, we mentioned Mr. Gensler seems to be the number one person who's an issue with cryptos at the moment, and we'll see how that works out. I hope he understands how history might judge him, and that is this fact that this space has the world's most unique example of global free market capitalism I've ever seen. And on a base, everybody can get their phones and trade it and do anything. And it's gone for the dollar organically. Like I said, the most widely traded cryptos on the planet are the U.S. dollar. New tokens. To me, that's profound. The U.S. regulations and leaders seeing that are probably not going to mess that up. And to me, that's where it's all going to go forward, big picture, positive. In the meantime, look over to your right. What's the Fed doing? What's the stock market doing? They're going down. And cryptos are just the highest volatile, whip them around assets. So they're going to go down with the tide, but then they'll probably trade much better when things recover.